It's called the Inflation Reduction Act, but don't be fooled by the name. It doesn't actually decrease the inflationary pressure we all feel at the gas pump, at the grocery store, clothes shopping. It actually makes it worse.
But some of us may have forgotten how the law got its name in the first place. It was meant to be the rare bill that included both spending and how to pay for it, in part by imposing a 1% excise tax on corporations buying back their own stock.
There are times when stock buybacks make a lot of sense. And frankly, they've made a lot of sense when interest rates have been at record low amounts, which has allowed companies even to borrow money to do stock buyback. That, though, seems like it's gaming the system. And I've been disappointed when companies have said, lower our taxes and we're going to invest more in plant and equipment, and instead they use it for stock buybacks. So putting a 1% tax on those stock buybacks, I think, makes sense.
What is the purpose of stock buybacks? When are they appropriate? And when can they be a form of gaming the system, as Senator Warner warned about when the IRA was first passed? It turns out that they weren't even allowed in the United States until fairly recently.
As simple as the name. It's when the company buys back its own stock. And there's a reason that this was illegal until 1982.
Nell Minow has spent a good deal of her career studying stock buybacks. She is now vice chair of ValueEdge Advisors, where she advises institutional investors like pension plans about stock buybacks and how they can affect the value of the companies they invest in.
I think they did it because at the time they felt that buybacks would only occur when there was excess cash and undervalued stock. But there are a lot of moral hazards there because sometimes companies that should be spending the money on operations and research and marketing and things that are more directed at long-term value will spend them on the quick hit on the stock price that you get from a buyback.
Despite the moral hazards, economists generally favor allowing stock buybacks as one way to allocate capital efficiently. Glenn Hubbard served as the chairman of President George W. Bush's Council of Economic Advisors. He went on to serve as dean at the Columbia Business School, where he remains on the faculty. His book, The Wall and the Bridge, set out some of his ideas about how to invest in the country and the economy.
It's a way to get cash back. Economists for years talked about so-called agency problems in the company, that there may be too much in the way of internal finance that gets wasted. Paying the money out stops that. Dividends tend to be very regular. Companies don't like changing their dividends a lot and then having to bring them back down. So share repurchases are one way to get cash back to shareholders.
So from an economist point of view, they might allow more efficient allocation of capital. If it's not doing so well with the company, maybe I should have it and put it someplace else.
They definitely do. If too much money gets trapped in, let's say, an old style company, why not put it in a new company where there are better opportunities? Obviously, there are costs and benefits. I'm not saying it's one-sided, but my own prejudice as an economist is buybacks are just fine.
That's what I represent shareholders. We love to hear that. A stock buyback, a special dividend, absolutely. If you haven't got a good idea for the money, give it to us. Let us decide what to do with the money. That's when buybacks work to the right way.
Whatever their advantages or disadvantages, stock buybacks have become a central part of corporate finance since the SEC first gave them the green light. They're estimated to have reached $1 trillion in volume in 2024, roughly double what they were 10 years ago, led by some of the Magnificent Seven, like Apple, Alphabet, Microsoft, and Meta, followed by some of the big banks. But the executives putting the buybacks in place have particular incentives that can influence their judgment. They can increase management compensation as the number of shares bought reduce the denominator of earnings per share without adding to the earnings numerator.
The first red flag is when they don't adjust the EPS targets for incentive compensation. There are two ways you can hit your EPS targets. The way that we like as shareholders is to increase earnings. The way that is not as beneficial to shareholders is to decrease the number of shares outstanding. And so for a board of directors compensation committee to set the EPS targets and then do a buyback, that's a very easy way for them to hit those targets without any real benefit to shareholders. You have to remember that there's another element of manipulation, and that is that the executives control the timing of the buyback. And sometimes they do it in order to hit those EPS targets. Sometimes they do it just because they have no other idea about how to increase the stock price. But we want to see them increase the stock price by doing a better job.
Which is where the board should come in if it's doing its job.
The board has to be focused not simply on the mechanics of EPS, but really what are the growth prospects for this company. If you were doing that, you would be eating your seed corn and you'd get caught napping by the market. So a good board should stop that.
Most often, management justifies a stock buyback as just a prudent investment, claiming that their company's stock is not getting the respect in the market it deserves, that it's undervalued, which makes it a good buy. But it's harder to make that case when market valuations become elevated as they are now.
But remember that the original concept of the buyback was exactly what you said, excess cash, and the stock price is lower than it should be. In other words, the stock is a good investment. Just like any other asset allocation made by the executives and the board of directors, you look at it in terms of return on investment. The stock market has been very high, as you know, in the last couple of years, and so it's really harder to justify buybacks. It's harder to argue that the stock is undervalued.
And whatever the overall valuations, it's awfully hard to reconcile management's claim that its stock is undervalued if members of the management team themselves decide to sell their shares into the buyback.
The other one that bothers me even more is when the executives sell into the buyback, which I think should be prohibited. The whole justification for the buyback is that the stock is undervalued. Well, if it's undervalued, why are you selling?
Well, in general, I think when managers are selling, it's one of two things. One, so-called 10b5 plans, where they have regular opportunities to sell and it just happens to be at that period. Or there could be a particular event in their personal life. But I agree with you. Yes, management in general should be holding shares during the tenure in which the manager's in charge.
So what does all this mean for the Inflation Reduction Act? Now that it's been in force for over 2 years, what are the results? First of all, did it raise much needed money for the federal treasury? The Joint Committee on Taxation estimates it contributed $7.9 billion in 2024 and will add up to about $74 billion over the 10-year period ending in fiscal year 2031. Certainly a nice contribution, but not likely to put a big dent in the $1.6 trillion the Congressional Budget Office estimates will be added to the federal debt every year for the next 10.
I think of the game show Jeopardy, where if you give me an answer, I guess the question. So if it's stock buybacks, one possibility for the question is what is revenue? But they actually don't raise much revenue. The U.S. buyback at 1% maybe raises about $7.5 billion a year.
And if Senator Warner thought that the tax on buybacks would reduce the appetite for them, it doesn't look like it had that intended effect either. Stock buybacks have continued to grow despite the excise tax.
I would say that stock buybacks have been bigger and bigger every year. We've seen some of the biggest companies in the country buy back more and more stock. And we've seen very little benefit to shareholders, except in a very short-term way, and more benefit to the executives. So I think it has become a genuine problem. One thing that I know will never help is taxing it. There have been a number of proposals. It was included in some legislation. Those expenses are just passed right on to the shareholders and sometimes the consumers as well. Companies are completely indifferent to paying taxes.
When you mention taxes, the Inflation Reduction Act does have a 1% excise tax on stock buybacks. Yeah. What effect did that have on stock buybacks?
Not at all. It was gasoline on the fire. They just kept growing and growing.
And perhaps most basic of all, when does it ever make sense for a company to do what Senator Warner was particularly concerned about? A company borrowing money to buy back its own stock, given that the entire theory of allowing buybacks was to let companies make constructive use of excess cash.
In reality, like a lot of other financial structures, it got abused. I mean, when I saw that people were borrowing money, companies were borrowing money to buy back stock when the stock was at a record high, I realized that the original justification had just completely been forgotten.